investment scams are now the highest loss form of scam, and they're up more than 2.5x over the last year.
Hi, welcome back. My name is Ronit, and with my partner in crime, Gaurav, recording live from Dubai again this week. Both Gaurav and I are back in town. We have Simon Taylor as our guest. Simon, who and what are you?
I am a meat popsicle, if you get that reference. No, hi, hello, I'm Simon. I'm a fintech nerd, I guess is the best way to describe it. 20 years in financial services, worked across everything from payments, a company called Thesis. I worked in Barclays doing some payments change over there. I then was on the founding team of Barclays Rise. So some listeners will be familiar with that, one of the early fintech accelerator programs inside one of the banks. Then was asked to be head of crypto R&D over at Barclays, which was very, very fun. And when you're head of crypto R&D at a bank in 2014-15, you get rolled out in front of lots of regulators and lots of clients. So I started to learn about their world. And then spent about six and a half years co-founding an organization called 11FS, the FinTech consultancy, best known for its FinTech Insider podcast. So if the voice is familiar to anybody, hello, nice to hear from you again. And I spent about the last 15 months working for a company called Sardine. And if that sounds fishy, it's because we're about catching fraud and suspicious activity. Suspicious activity reporting, SAR is the SAR in Sardine. And I also run a blog called FinTech Brain Food, which, I'm a hungry guy. I'm always trying to eat that curiosity. So I'm here for the FinTech. And you guys said, hey, we've got a FinTech podcast. And I'm like, I like FinTech. I like nerds. You guys seem like both of those things. So let's hang out.
So Simon, you've been the FinTech man about town in London and virtually around the world now for many years. And we'd love to get your thoughts on where we are in the proverbial cycle, the famous cycle. And I'm now thinking of Fisher's cycling, but it's, where are we in the FinTech cycle? Was fintech simply a product of the mid 2010s, the late 2010s, when capital was plentiful and we'd all discovered this thing called the mobile internet, and banks were generally a bit slow at adapting to this new internet age? Was it just a flash in the pan and we're now all grown up and we're moving on to other things, or is fintech here for good?
Was it a ZERP phenomenon?
Was it a ZERP
Zero
phenomenon?
interest rate phenomenon?
Yes.
Like all things in life, the answer is both yes and no. Very rarely is the world wonderfully binary or black and white. Of course, we have mobile, we have social, we have cloud. All of these things are macro trends, but isn't it interesting that the first adopters were not the big institutions? Isn't it interesting that this company called Stripe comes along and builds these piddly little things called APIs? And oh, that's cute. And this thing called Square comes along and it builds this little terminal and it plugs into an iPhone. Oh, that's cute. And then suddenly these are big enterprises. But didn't these big enterprises get ahead of their skis? Weren't they overvalued? Well, yeah, but they're multi-billion-dollar enterprises with meaningful market cap. So is that a flash in the pan? Probably not. Was it overpriced? Probably yes. So there's a zoomed out perspective, but I think the zoomed in perspective is it got faster and cheaper than ever to build new financial services products. And that enabling infrastructure unleashed a wave of innovation. That wave of innovation had this rocket fuel called VC funding that was phenomena based. But that rocket fuel brute forced a lot of interesting ideas into the market, many of which won't survive. But they call it venture capital, not patient capital, not risk management. It's a different type of business. They're looking for the home runs and they're willing to tolerate pain and losses in the process. Somewhere along the lines, we forgot that. It started returning a little bit too well. It started correlating a little bit too much. But actually now we've reverted to the mean, and most funds are not outperforming the NASDAQ. The NASDAQ is outperforming most funds and most asset classes. So reality has resumed, and that's a really good thing because what's that going to do? It's going to wash out the crap and force the strong to survive. Sorry if people have been let go. I don't mean to call what you did crap. You're very, very important. But from a business idea, it is survival of the fittest in a free market economy. I think the last thing that's really interesting, though, is we're kind of seeing the higher interest rate environment change the game again. This is really like if you look at what certainly what I'm seeing platforms that help you hedge foreign currency risk. I'm seeing platforms that help digital businesses buy US treasuries do extremely well with higher for longer rate environments. So fintech is just the first to get to whatever the new opportunity is. And the new opportunity has moved. It's not just here's a mobile app and a debit card anymore. It's the entire value chain. And that's really, really interesting.
Now, if I unpack what you've just said there, there's lots of really interesting threads, but there's two big ones. One is the product side, for want of a better word, what we're building in the fintech world and why that was necessary from APIs onwards. And then there's the kind of financing side or the risk premium interest rate side. And obviously the latter helped rocket fuel the former. But let's just keep those for, even though they're interconnected, slightly separate. On the product side, what would you say right now, whether it's in the UK or in the US or elsewhere in the world, looks really interesting? Just like in the early to mid 2010s, you had, the neobanks emerge and the next generation payment companies like the Stripes and the Squares. What looks really interesting in the early 2020s and the mid 2020s from a product side?
So I have two mental models to throw at you before I answer that question. The first one is
Okay.
the idea of crossing the chasm. So you're
Mhm.
probably familiar with the innovators, early adopters, early majority, late majority, sort of bell
Mm,
curve of adoption of any product. And
mm,
to my mind, there's a lot of consumer fintech products that have crossed the chasm. The neobanks, the digital banks have kind of crossed that chasm. Some of them have got banking licenses and they've either started into or have just come out of their difficult teenage phase. So now instead of going goth, they've got to get a job, they've got to hit profitability, they've got to grow up a little bit. And you see this happening around the world. So you've kind of got this like 10 to 15-year-old company going through maturity, going towards the early majority, starting to have to cross the chasm in that space. So what
mm,
happens in those mature segments that have been around for a little while, it becomes a cost and efficiency battleground. And
mm,
they really start to play in interesting ways once it does become a cost and efficiency battleground.
mm,
That's, but if you think, so that's the crossing the chasm side and things that have done quite well. The second curve I'd give you is if you observe where fintech started, it starts with the low hanging fruit. So it starts with consumer, and it starts with consumer debit cards on a mobile app. And then it kind of adds peer to peer payments, and then it adds small businesses, and then it adds investing, and then it adds. And now we're seeing much more sophisticated sort of get access to almost like a private bank in your pocket, or we're even seeing come up the complexity curve where spend management platforms for mid-sized enterprises are starting to think about how do I hedge your FX risk and how do I do things that would have been traditionally sitting in global transaction banking. So we're coming right up the complexity curve towards trade and working capital, towards GTB, but dare I say it, towards fixed income and towards this sort of area of space that you wouldn't have dreamed fintech companies would have played in. That's the profitable bit of the bank. We know we have to run the branches and the distribution in order to get the deposits, but this is the bit where we really make money, right, guys? Well, maybe not in the future. That's starting to change a little bit, and of course, reality is almost always more complex than a simple battleground. But I think the next wave is way at the top of this complexity curve. We're coming up into those product sectors like fixed income, like capital markets, like GTB, like trade and working capital, and that's where the action is. And that's going to start by classic innovator's dilemma: segment the market, go after the long tail. What does trade and working capital look like between India and Latin America? Because those BRICS countries want to trade bilaterally. They don't want to necessarily have to go through the US dollar. So who's providing the lending into that? Who's providing the digital platforms for the digital businesses of tomorrow? That fintech space is really, really exciting and really, really interesting. So you can't separate fintech from macro, and you can't separate macro from fintech. But that coming up the complexity curve, I find hugely exciting.
And if you look at the second bit, the macro, more specifically, the financing part of this all, I mean, you're very connected into the ecosystem in the UK. You work for a US-based company. What does it look at? Are we seeing the cycle stabilize and come back? I'm thinking fintech and Web 2 rather than crypto and Web 3 now. Are you seeing any signs of stabilization slash recovery yet?
It looked dangerously close to it for a little while, and now there's the higher for longer. There's a bit of that going on.
Yeah,
Certainly, seed was always strong. Series A's
right.
got better, and there's a lot of dry powder in funds, but VCs aren't necessarily wanting to deploy because they can't necessarily
Mm,
pull that off their LPs, who
yeah.
are thinking about NAV quite closely at the moment. So
Mm,
there's this sort of well, I want to back the founders I believe in, but if I was running an M&A boutique, I would be making
mm,
bank right now because there are so many founders who are kind of stuck at this 10 million run rate with a nice business that aren't venture
mm,
scale. There are so many VCs who kind of don't want to tell the founder that they're not going to be the one that returns the fund, but they kind of know it in their heart of hearts. And there are so many acquirers that are stuck not able to enter new markets, and a lot of incumbents that are frankly eroding market share from where the market opportunity is. This is a triangle that solves itself. So this is a very solvable picture. That opportunity aside, I think from macro, the ones that the VCs do back and do believe in that are still showing growth, and there are absolutely companies out there doing it. Like I said, in this trending sort of space. I mean, I have the good fortune of working in an area where, good fortune of unfortunately working in an area where fraud is exploding. Anti-money laundering is getting a much, much worse problem since the pandemic. So Sardine is in prime real estate. You know, this is a big problem area. Everybody wants to go solve it, and so I'm sort of protected from that. But yet, as I speak to the rest of the market, it looks very different. So you're getting folks like Ramp.com that just raised another round, and there are these sort of somewhat resets in valuations and normalizing of valuations, but the very best companies will be absolutely fine. It's everybody else and where do they go and where do they land that we've kind of got to think about.
Um, Gaurav, I want to bring you into the conversation in a nanosecond, but before you do that, I'd love to hear you delve into the sort of Sardine story and building Sardine. But before you do that, Simon, can I just ask the same question I asked about fintech, but specifically about crypto? And guess given in the past, whether it was at Barclays or 11FS, you were kind of quite heavily involved in the blockchain world. We said fintech, was fintech just a ZERP phenomenon? Was crypto, from a market perspective, just a COVID
Yeah.
slash ZERP phenomenon? Was it just, and there are lots of reasons why, blockchain technologies, from payments uh, to self-sovereignty to evading capital control, a lot of use cases. But the huge amount of attention and
Yeah.
financial capital that went into crypto in 2020, 2021, was that just a COVID ZERP phenomenon?
Uh, Insofar as meme stocks were, yes. I mean, I think there was a bit of meme stock
Hmm.
in crypto, and there's a bit of crypto in meme stocks. Like, yes. The boredom economy was real. People were home and these numbers were trading, and it was a bit like gambling, and everybody was up to it.
Hmm.
Classic late stage bubble. Uh,
Hmm.
that all said, two things can be true at the same time. There can be a classic late stage bubble, and there can be something very interesting going on from first principles. And I think from first principles, we've never had a natively global, natively 24/7 kind of record of truth, golden source that is programmable. That's amazing. Imagine having programmable contract logic on a ledger that everybody can see and access. How would you build a financial system around that? What might you be able to do? So the potential is there, but often people overstate the pace of change and understate the impact. And this is a classic example of that, we got ahead of ourselves with fintech, we got ahead of ourselves with crypto. But if I'm sitting in Argentina right now, then having a US dollar stablecoin seems like a really good idea because I can go into the United States. I can legally open a bank account as a foreign resident. I can withdraw 10,000 US dollars that I've been paid by a US employer. I can then stuff that into a briefcase, fly home, and hold on to those US dollars. And in doing so, I would have a far better exchange rate and hedge against local inflation than I would trying to bring it through the formal banking system. That digital cash is hugely exciting. And I think these trade flows are opening up. These
Hmm.
ways of using alternative tokens are starting to open up, but because it happens at the edge. Do you remember? I actually worked for a payments company. I named some of my career history, so smart people will figure it out. And I remember showing Stripe to them when it was founded, and them going, "Oh, Simon, you just love this stuff, don't you? They'll never amount to anything." And there were other people around me, that felt the other way. So, like, I'm not throwing them entirely under the bus, but that's generally the consensus around anything new,
Of
especially when the
course.
new thing goes backwards a bit. Because
Hmm.
you get to sound really smart by being cynical. You get to look
Yeah.
really great if you go, "Oh, I see, I told you so," and everyone goes, "Oh, look at the smart person who told me so." Being the optimist, that's a lot
Yeah.
harder. Being the person who's like, "Yeah," but counter-cyclical, that's where you want to be. Do you want to be consensus correct, or do you want to be non-consensus correct? I'd rather be the latter. Although, if I was really great at picking winners, then who knows? I'd probably be on an island somewhere with Richard Branson.
There's still time, Simon, to be on the island and to improve your tennis game at the same time. Everybody has a very mean tennis game. I want to bring Gaurav into the conversation because some of these topics we're talking about in terms of the fintech ecosystem, over in the VC funding cycle, he's got a very interesting perspective on because particularly in the Middle East, but not just in the Middle East and Africa, given your investments and your interest in the US and other places, Gaurav. Gaurav, where do you think we're in the cycle? Like, were all those
It's
500 investments you did just some fun when interest rates were zero and we were all
no,
young?
I, I,
Not
I,
young, but you know.
I wish. I mean, I'm the crazy optimist in fintech, right? I'm the person that went out there and said, you know what, I'd love to have a pot of cash that I could invest in enthusiastic, well-meaning
Mm,
founders that know more than me in a specific space in fintech. And knowing what I know about the fintech world, I could give them some building blocks so that at least they are stable as they go out on their journey, and maybe even
mm.
bring more intelligent people to the cap table as much as possible. And I went out with all this energy, and I just blindly went forward because, as Simon says, it's much harder to be the optimist. And I was that person 20 years ago that wished somebody invested in me.
Let's zoom in on Sardine, putting the SAR into Sardine. Do you wanna
Yeah,
lead
I would
the examination of Sardine? Over to
I
you.
would I would absolutely love to. Simon, if you don't mind, could you just tell us what is Sardine?
Yeah, so it probably makes sense to start with the founder, Soups Ranjan.
Yeah.
So Soups worked over at Yelp as a double PhD in data science. His job was to do bot detection. So many bots, advertising, that whole space. He's really early on in sort of detecting things that are coming through that are fraudulent in advertising at high frequency. In 2014, he was recruited by Coinbase to solve their biggest problem from a data science perspective, which was fraud and anti-money laundering, early days of Bitcoin. And that is an interesting problem because not only have you got the world of crypto and everything going on there, but when you're an exchange, you've got the world of financial services. And he notices in financial services two problems. One, all fraud and risk problems are data science problems, but he's lacking the data he needs to be a data scientist. And not only is the data missing, it's the quality of that data is very, very poor. And so all of the other vendors in the space will say, well, this transaction is an 897. He's like, well, what's that mean? How did you get to that score? Can you give me the data, please? No. And all the other vendors, this looks like money laundering, but we'll tell you in 3 days when our batch cycle runs. I said, well, but I'm a data scientist. I'm a machine learning guy. I want real time. I want to build models. And then lastly, there was just a general mistrust of machine learning at the time. So what he did is he would run the machine learning models side by side with rules created by the team, and then sort of compare and contrast them. He built simple KPIs and found ways where the machine learning was better and found ways where the humans were better, and kind of always kept them together. It turns out now that's considered widely best practice, but it was almost impossible to do. Now, if you go look inside every financial institution and every fintech, they're having the exact same problems Soups had at Coinbase. So in 2019, he went to Revolut, had the same issue, too many vendors, all black boxes, screw it, the only way to fix this is to go do it myself. So in March 2020, he co-founds Sardine with Zahid and Adi. Zahid and Adi, so Zahid's background was at PayPal. And what he did at PayPal was build all of the device intelligence and behavior biometrics. So Gaurav and Ronit, when you guys use your phone, there's a certain speed at which you type. There's a certain way you swipe that makes you uniquely you. Now, what's really interesting is 90% of fraud and money laundering comes from fully verified identities. Now, of course, we don't count all of the fraud we dissuaded from having KYC. So, that's a slightly biased figure, but that's set against exponential increases in fraud and money laundering. So with deep fakes, I can now steal your face. The dark web has all of your data. So I can probably create an account as you. I can probably hack you. I can probably use all the data signals, but I can't quite use a device the way you would. I might be able to take your voice. I might be able to take your face, but I can't use a device at the same time in the same way you would. But a machine learning model is very good at noticing those idiosyncrasies, those thousands, millions of tiny little details that add up to make you you. And it turns out that is now the most important way to prevent and detect and manage any kind of risk, behavioral biometrics and device intelligence.
Have you built that yourself or you're using somebody else? Because biometric behavioral analysis has been around for 3-4 years pretty strongly. It started about 7 years ago, infancy, 8 years, but now it's really coming into it. So you built it in-house?
It's intellectual property. And so it's self-built. And part of the reason, again, was a lot of those companies that exist started out in e-commerce. So they're not looking in the post-mobile world. They're not necessarily looking from a fintech perspective. And also, frankly, they've gotten to a certain size where their R&D velocity has decreased. So I often like to describe Sardine as buy fraud nerds, fall fraud nerds. It's like, this is what you would build if you had just a venture capital backing you to do nothing but build the best fraud ops tool on the planet. And so they go super deep on the best signals. And then what we do is we buy in signals from everybody else. And again, by fraud nerds, we get everything from open banking to what's happening in crypto to adverse media for sanction screening, you name it. We're pulling in all of that data that as a fraud team might be hard to get your hands on, but we have no other focus but going to get that data, building the best machine learning models by fraud nerds, for fraud nerds, but anchored around the device and the behavior. And that device and behavior is I would describe its core differentiator as much more fine-grained. So we're not just looking at things on the device like, is there a proxy, isn't there? But we can also detect things like remote screen sharing. We can also detect tiny idiosyncrasies like the age of a person by how they hold their phone. I don't know if you've noticed, but my arms are getting need to get longer and longer, and I'm needing to lift my glasses to look at my phone. I've reached that age. There are certain ways through the gyroscope of the phone you can start to predict somebody's age. If the phone is facing upside down, isn't that weird that somebody's tapping the screen but the phone's facing upside down? All of these tiny details start to add up. Fraudsters use their mouse differently. The background sound sounds differently if you're in a offshore center. If you are using a proxy and a VPN, your time zone on the device won't necessarily match your geolocation, which might not match something else. All of these tiny little things, you are constantly looking for needles in haystacks. And so what you need is a data science nerd looking for needles in haystacks, taking a data science approach to stochastically building models around what's the most valuable for performance.
So just to recap, fundamental issue is the way KYC is being captured is not sufficient to beat fraud on a long-term basis of how it's evolved to common-based technologies for users, number one. So you rebuild how the fundamentals of what KYC really looks like to capture users' identity.
So let me flip that inside out.
Yeah.
Sardine is one API, one platform, one SDK for everything you need from KYC across your risk spectrum through to anti-money laundering, SAR filing, you name it. It's the whole case management. It's the whole spectrum. So we do partner with people to help you manage KYC and that customer onboarding. Not only are we doing all of the things you have to do from a compliance standpoint, we're also looking for lots of other little details to make sure that we're improving that part of the journey. But we know still some fraudsters will even get through that. So then every time you go to load the account, every transaction, every interaction, we're looking for additional signals and we're trying to build a confidence score throughout the entire life cycle, whether you're making a payment, whether you're receiving money, whether you're just logging in, you name it, we're trying to figure that out. So it's not just so I think one of the fundamental problems is KYC is not enough. We can still enable you to do it, but it's not enough. From a practitioner standpoint, the problem we solve is trying to fix the KYC is not enough. A, you probably lack the budget to build it yourself the way you'd want to. And B, even if you've got the budget, then you've got to maintain it and keep pushing the boundaries of what's possible. And so that's going to get really expensive from an OPEX standpoint. And even if you can afford both of those things, doesn't hurt to have a little bit more info and data coming from somebody like a Sardine who happens to be really good at device and behavior. So that's kind of where we play.
Then who do you benchmark as your closest competitors or perhaps counterparts in the ecosystem as a comparable? If you were to say, there are three companies which sort of row in the same boat, going back to that example, it would be Sardine and who do you think?
Yeah, so I guess it depends whether you want to look at it horizontally or vertically. If you look at it horizontally, I'd say Alloy and Unit 21 are the obvious examples. So they are horizontal platforms. Sort of Unit 21 starts very much in the compliance side and works its way back to fraud. Alloy was always the kind of the orchestration platform. And for some people, that's what they need, and that solves for them. And Unit 21 is very, very mature on the compliance side. The difference with Sardine, I suppose, is it's a little bit more opinionated. So it's less of a Lego box. It's more of a, here's how you get the best performance. If you want to change it, you can, but this is the opinion of what will get you the best performance. And it's anchored really in that most important data science signal, which is the behavior device. And then if you look at it kind of more vertically, the vertical side is you would look at a threat metrics, a biocatch, a behavior sec, the device and behavior type of companies that are out there that are now starting to go horizontal, but don't go as horizontal, and then don't go as necessarily as deep from an IP standpoint.
So Do you have that kind of a number? I know it's a long way to reach this point. Do you have that kind of number which makes it super attractive for people to adopt your technology and solutions from a fraud and a reduction rate and a money savings rate, where you talk to somebody and say, I can save you tens of millions of dollars or 5 million hours? Or is there something where you're showing value so quickly off the bat that people say we need to talk more?
Study is coming soon. So unfortunately, I don't have that available and in the public domain, but that study is coming soon. Let me give you an anecdote. That I'm yet to see a POC where we lose that POC on the quality of ROI consistently, because we are data scientists. We win. From a fraud standpoint, it typically depends on what's your goal. So you're either trying to increase conversion, or you're trying to reduce fraud, or you're trying to do a bit of both. And generally, we can massively improve. So if you've just got like an incumbent set of vendors in there, will be night and day. But compared to the competition, we'll typically benchmark. And this is always, again, the data science nerds are behind me. Sort of, they wanted this independent study because it's like, we need the methodology behind it before we go quoting numbers. I'm like, come on, guys. But I can tell you that one client turned us on, and within a month, they wanted to reduce fraud, and it was down 31%.
Wow,
client,
that's huge. 31%.
Yes.
I mean, usually 0.31% is enough. 3% is enough.
Generally, this was a client with pretty good practices. Oh, and they had a zero impact on conversion, by the way, because you've got to think about fraud and payments as a pincushion, right? So if I really tighten up fraud, I might hurt my sales.
Correct.
So it's how hard do you push down? So the other thing we can do is like really improve your conversion at the same fraud rates. The win-win, the Goldilocks, is we're going to push down your fraud and we're going to improve your conversion, and we can do a bit of both of those too. So it depends on who you are, depends on what you're looking for. I think the big one though is really around the high impact stuff. So the account takeovers, the scams where somebody loses their life savings. One of the things Sardine is uniquely good at is detecting scams before they happen. So investment scams are now the highest loss form of scam, and they're up more than 2.5x over the last year. So investment scam, somebody targets an elderly person in their 60s, 70s and says there's an amazing investment opportunity. All you've got to do is sign up for this crypto thing, enter your details, and you'll be fine.
Hey,
the
presto.
problem is, the elderly person might struggle. So what they'll do is they'll coach them over the phone. So what are we doing? We're detecting call in session with this same number time and time again whilst they're signing up for an account. That's weird. The other thing, sometimes they might even struggle to just enter their details on their old desktop machine or whatever it is. So the fraudster goes, don't worry, install this thing called TeamViewer or Citrix or AnyDesk, and I'll be able to help you do it. And so, again, a lot of folks can't detect that effectively. We detect it with 96% accuracy that has been installed. And so we send that signal to whoever is having the account signed up for, to like, hey, hold this payment. This person might be in the process of losing their life savings. So what's happened? The elderly person has gone to sign up to a service with their real identity and gone to move money, and they've authorized the movement of that money. But what they've effectively done is been tricked into sending that money to a fraudster, and in most jurisdictions, they have no legal recourse, and there's no liability for what you do about that. That's changing in the UK. There will be a 50-50 liability split between the sending bank and the receiving party. That's why we're seeing quite a lot of joy in the UK at the moment, and I think there's also the high impact that has on an elderly important customer. That's an area where we can make a real difference as well.
Simon, thanks a lot for your time. I wish you and your team all the best. Please do circle back when that report is back out. We'd love to attach it as an update to this episode, and look forward to connecting afterwards and seeing what we can do about helping some people out on the M&A side. Thanks a ton. Ronit, back to you.
Just to maybe wrap it up, Simon, two more questions from me. The first one is, we can't have a podcast without spending at least a fair amount of time talking about Gen AI.
Keyword note, tick, done.
Hashtag Gen. So, Sardine, is there like an AI? I mean, I know these are data scientists, but what's the in a world of deep fakes, I was chatting to the pin drop founder the other day, and oh, that was fascinating. In a world of deep fakes and just sort of, people not just social engineering fraud, but people copying our voices, our images, and so on through deep. How does Sardine fit into all of this? And apologies, that's a dumb question.
No, no. If you go to sardine.ai/blog, we've got a full breakdown of how fraudsters are using generative AI and
Right.
how to detect it. One of the most
Big
interesting
ones. Save the audience reading the vlogs.
Yeah, well, so TLDR, fraudsters can already jailbreak ChatGPT or any of the other LLMs relatively simply to generate realistic looking scams. What does that mean? It means the rate of scams has dramatically increased.
Mm.
The cost of creation has dramatically decreased. With scams, you either went wide and generic, so Nigerian prince scams, etc., but poorly spelled, or you went really, really tight and really, really deep. Hi, this is a text message from your CEO, but it's actually from the wrong number, business email compromise. And so you go really specific. Now, the cost of that is much, much higher to try and get specific to that person at that point in time. Hi, name, this message is from name. That takes a fraudster some time. Now they've got the best of both. With Gen AI, they can generate lots of realistic looking stuff almost instantly. They can generate deep fakes. How do you detect that? Well, here's the dirty little secret of everybody selling fraud and compliance software. There's no such thing as deepfake detection. It doesn't work. It does not work. What does work is detecting a human a different way. Look, you can't look for extrinsic signals. I can't look at your face. I can't look at your voice. I can't look at anything external to you. Have to look at the intrinsic signals, the way you type, swipe, tap, and that is effective, and we have the data on it. So we go into a lot more detail on that blog, but Gen AI is scaling up scams, but it's also scaling up fraud ops teams, frankly. If you've ever had a chargeback, you have to submit compelling evidence if there's a dispute. That takes a long time. Wouldn't it be great if Gen AI could help you along with that? If you ever had to submit a SAR, you need to submit something called a SAR narrative. Wouldn't it be great if Gen AI could just take the details and submit a really good SAR narrative to get? So, we have that. We have an internal chatbot. We're doing all of the things around Gen AI that you would expect. But Gen AI at its best is a really good analyst. It's a really good college graduate that has no context for what you want to do. So the best thing you can do is give it some context, and that's what we're doing. Is we're building up Finley, which is our Gen AI bot, which is an extension of your team. But generally, the best way to detect generative AI-based scams is with machine learning. And whenever I speak to CTOs, chief data officers, they go, finally, somebody who's not just jumping into the hype, but actually meaningfully making sense of it. Gen AI in 2 to 3 years, absolutely massive. It's going to be huge. Gen AI as a tool I use day to day internally for my operations, a tool I use to manage risk, a tool I use as like chatbots 2.0. Amazing. Gen AI to detect Gen AI does not work. Any Gen AI detection, deepfake detection does not work. It just doesn't work. There are so many scientific papers on exactly this point. So what you need to do is detect, is there a human? And the best way to do that is to detect, are they behaving like a human?
How does one behave as a human? That's such a fascinating rabbit hole. But maybe the last question before we get in the wrap. You've been in finance a long time. You've been in fintech a long time. When you look back on your journey into fintech, from like say traditional payments and finance, and that kind of fintech, the kind of the fintech dreams, or the reason you went into fintech or pivoted into fintech and crypto, what hasn't happened yet? Like what, think back to Simon T minus 10 years. You're still young, but even younger Simon, what did you sit there and tell your mates? This is why I'm all in on fintech, and this is how we're gonna change the world. And
yeah, I thought open
sitting here in 2023, 24, and like shit, that still doesn't happen.
I thought open banking payments would happen faster. I
Right.
really thought open banking payments was going to be much, much bigger.
Yeah.
And it's a decade on, from
Yeah.
like PSD2 being announced, and that's overstayed the pace of change
Mm.
by a factor of two. It's like, oh,
Yeah.
come on, guys, get on with it. But the problem with regulated open banking is like it's regulated open access to current accounts. Like, whereas the free market model,
Yeah.
it's like 60% of the time it works every time, but you can have anything you want. And
Yeah.
so we don't have open finance, we don't have open banking, we have these
Mm.
hodgepodge mixes. But I do think if you could marry the data about a payment with the payment itself, that's still absolutely amazing. And everybody selling open banking payments is selling you cost reduction versus cards. Wrong
Mm.
sales pitch. The best sales pitch in the world is more revenue. It's what worked for buy now, pay later. It was what sell more revenue. So how am I going to help you get more revenue with open banking payments? I'm going to kludge in the data and I'm going to do blah, 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 loyalty, you name it, figure that out.
Mm.
So yeah, that's my big disappointment. Sorry, Plaid.
Simon Taylor, so much for joining us. We're going to have a follow-up and we're going to talk about humans, but we're out of time for this episode. So thank you very much for joining us.